At Safaricom, we are the forefront in supporting the affected families in partnership with the Kenya Red Cross. Through M-Pesa Foundation, we've mobilized 30 million Kenya shillings to support the initial relief efforts that include vital supplies, food, temporary shelter, medicines, and emergency medical kits in the affected areas. We are also supporting the first responders and volunteers, and also including supporting specific communities that are severely affected with free communication packages. We will continue to provide support that positively impacts those facing adversity, and will make other announcements related to this in the coming days. I'll now start with an overview of the operating environment during the period under review. This year has been transformative for our company, set against the backdrop of a dynamic operating environment both in Kenya and our continued expansion into Ethiopia. We operated under challenging conditions in both markets. This was driven by global and local macroeconomic factors. I'll provide more details on Ethiopia later in my presentation. Starting with Kenya, the Kenya shilling has been under pressure for most of the year, with recovery noted in Q4. We navigated an evolving regulatory landscape, including changes in taxation and mobile termination rates in Kenya. Even with food prices falling, our customers struggled to stretch their budgets. Let us now look at how we transformed lives during this period. Safaricom continues to be guided by a purpose of transforming lives. During this period, we accelerated our engagement across the globe to champion sustainability matters. We are transforming lives through bridging the digital divide and driving financial inclusion. We are intentional on addressing societal challenges by leveraging on technology for solutions in climate change, in health, in education, and agriculture, amongst others. During this period, we signed up the Forward Faster initiative, which calls on businesses to take measurable, credible, and ambitious action to accelerate progress on the achievement of the United Nations Sustainable Development Goals. Through the Chapadimba and Safaricom Athletics Series, we also created opportunities for our youth to launch their sports careers. As the biggest supporter of Kenyan communities, we exhibited our purpose in our innovations and through our foundation's initiatives, including Ndoto Zetu, which is now open. Let us now look at environment, social, and governance, which we call ESG, in a bit more detail. Our commitment to society remains at the core of our operations. As a result of our various ESG initiatives, we've grown 1.5 million trees, whilst over 3.5 million have been directly impacted by our foundations in the year under review. In line with our commitment to environment conservation, we've so far converted 23% of our sites to solar, and you'll see acceleration in the coming year. This is in line with our net zero target by 2050. We remain keen to create a sustainable business through decarbonizing our operations and advancing the circular economy. Looking at our strategy house, we've successfully executed our third mission, which marked the penultimate year of our Vision 2025. By leveraging technology, we are making digital products more accessible and driving financial inclusion across the region. Let us now turn our focus on how we are executing our strategy. We've sustained growth across our business by understanding our customers and leveraging innovation. Customer segmentation, public sector digitization, investment in big data, and acceleration of our agile journey are key drivers of the momentum that you'll see in our Kenya performance. We are now seeing more value from big data and analytics, with insights allowing us to serve our customers better. Agile has enabled us to deliver for our customers in a faster and more focused manner. In Ethiopia, we continue to roll out a world-class network, which is now almost half the size of the Kenya network by number of sites. Ladies and gentlemen, let us look at some of the key performance indicators, starting with our support towards digitizing Kenya. We are collaborating with the government of Kenya to enable the digitization of services and ensure no one is left behind. Under financial empowerment, over 23 million Kenyans have benefited from the Hustler Fund and the Women Enterprise Funds. We worked with 11 county governments to develop efficiencies in revenue collection and in management via the county app. M-Pesa continues to promote financial inclusion, particularly the unbanked and the underserved communities. We are supporting the government by disbursing funds to over 200,000 deserving Kenyans under the Inua Jamii program. Now, turning on our focus on our consumer business. Using big data and analytics, we are offering customers personalized and integrated propositions that support their usage and lifestyles. On 4G, which is key, we've ensured our network covers almost every Kenyan. We've also added 3.6 million 4G devices onto our network during the previous financial year, of which our device assembly plant has produced over 300,000 4G devices within just 5 months since launch. We are seeing the benefits from our refreshed customer segmentation. And as part of this strategy, we've launched Safaricom Hook, which is providing our youth a platform to find personalized services that suit their lifestyle. Looking at our mobile financial services business, as you see shortly, M-Pesa has had a robust growth, evidenced by a 33.9% increase in transaction volumes. This is attributable to broadening our mobile financial services beyond payments. Through solutions such as Pochi la Biashara, we provided our micro and SME with digital productivity tools. We have enhanced M-Pesa stability and reliability to offer our customers a worry-free experience whilst using the service. We continue to leverage on strategic partnerships to offer integrated value propositions, including and not limited to credit, savings, insurance, international money transfers, and global payments, amongst others. Let us now look at why we are positioned to be a partner of choice for large enterprise and micro, small, and medium-sized enterprises, which we call MSMEs. We are powering growth and innovation for our large and MSME segments through the Internet of Things, which is IoT, and ICT solutions. We are supporting MSMEs via the SME Digital Adoption Plan, which entails productivity tools such as cloud solutions. For large enterprises, we are scaling cloud and cybersecurity solutions paired with connectivity solutions. We have 1.5 million connections under the Smart Water Metering Program so far, and over 13,000 micro and SMEs are benefiting from our SMEs digital adoption products. Looking at our fixed business, our investment, both from an infrastructure but also from a product development, has paid off. We've driven affordability of our services by reducing pricing across all our fixed propositions by over 50%. We've simplified customer journeys. We've enabled our dealers to serve fiber customers, leading to improved customer experience. We've automated our incident management process to enable immediate outage notification. And also we continue to invest in 5G with those over 770 sites serving customers, primarily in urban and peri-urban areas. Our strategy execution and initiatives have been recognized and awarded. The awards are an affirmation, which you see on the screen, are an affirmation of the work we put in and our continued focus on the customer. The celebration and recognition across various sectors reaffirms our commitment to running a sustainable business. Core values such as sustainability, creating a diverse and inclusive environment, and caring for our employees are at the heart of our company, and we are honored to have been recognized for them. Now, turning on our focus to Ethiopia. Whereas we faced a challenging operating environment, we are encouraged by the positive engagement and support received from the government of Ethiopia and the regulators. We are glad to note the improved macros, including easing inflation and GDP projected to grow at 6.1%. On the regulatory front, the review of the MTR, which we call mobile termination rates, charges from 0.3 ETB, or rather to 0.3 ETB from 0.31 as from 1st of May is a positive step. As we look at the key takeouts of the Investor Day held in February 2024, I want to thank all stakeholders, some of whom are present in this room, who joined us in Addis. During our annual Investor Day, we have reaffirmed our view of Ethiopia as a land full of opportunities and critical to our future. The youthful population, coupled with low mobile penetration and rapid economic growth, gives us confidence in this market. Our view is reinforced by the growth in both customers and usage. Let us now look at what we have achieved in Ethiopia. We've doubled our 90-day active customer base to 4.4 million in the year, with 64% of these customers being active data customers. Our mobile data is a key proposition in Ethiopia, with usage per chargeable data subscriber averaging 4.3 gigabytes, which is now ahead of Kenya. We've recruited and onboarded agents and merchants to aid the rollout of M-Pesa services, which has already registered 4.5 million customers. We are building a world-class network that is currently almost the size of what Kenya's network is. Looking at our Ethiopia medium-term outlook, we remain focused on growing the quality of our subscriber base, both for GSM, which is our connectivity business, and for mobile money. We are accelerating M-Pesa penetration in the market. We are also monetizing opportunities such as mobile data, which has recorded very high usage. We are grateful to the Ethiopian regulators and the Ethiopian government, including the Prime Minister, for their support in ensuring a level playing field in the sector. And we are fully committed to scaling our operations to support Ethiopia's digital future. So how did we perform during the 2023-2024 financial year? I'm sure that's what many of you have been waiting for to hear. So you're wondering, Peter should stop all the stories. He should just go to the financial performance. We had an outstanding year in Kenya. And I repeat that. We had an outstanding year in Kenya. We also outperformed group guidance, which was a revised guidance at half year at a group level. And remember, we revised our guidance. At half year, we revised our guidance by $80 million at a group level. And we are also encouraged by our commercial progress in Ethiopia, as you'll have seen. Our Kenya operation is now a $1 billion business. And this is not a top line. It's a $1 billion business in earnings before interest, taxes. So what we call earning before interest and taxes, which is EBIT, which has hit 140 billion Kenya shillings, which is a 20% growth year on year. I think we should clap again. So we are now billionaires, yeah? In dollars. There, I should have said the currency is important. So on a consolidated basis, so that's the Kenya business, on a consolidated basis, incorporating the startup costs in Safaricom Ethiopia, the group closed on an earnings before interest and taxes of 94.9 billion Kenya shillings, which is a 3.5% growth year on year. And I need to emphasize this. This is a remarkable growth after having registered a negative performance last year in F23, which is financial year 23, and having delivered a higher than guidance of 93 billion, excluding what we call hyperinflation, which Dilip will explain. And it is incorporating all the startup and investment costs that we have incurred in Ethiopia. So on an overall group, service revenue grew by 13.4% year on year. So double-digit growth to 335 billion Kenya shillings. And now we are already seeing the contribution of Ethiopia coming through, and you'll see that when the CFO presents. Our group net income, excluding minority interests, recorded a growth of 1.2% year on year. So we expect from financial year 2025, Ethiopia will start being a significant growth contributor for top line and an accelerator on the bottom line. At this juncture, I want to hand over to our CFO, Dilip, to come and talk to us on the performance of our business overall and also Kenya and Ethiopia in greater detail. Thank you very much.
Thank you, Peter. Morning, everyone. I'm Jambo. I was wondering whether I need to present any other numbers after this last slide, but I still think there is a lot more to talk about. So let me first start by acknowledging once again the great results that we have seen in Kenya and the commercial momentum that Peter mentioned about for Ethiopia. So in the next half an hour or so, I will provide an overview of our accomplishments in greater detail. And as all of you know, the results material will be available in our websites pretty soon, so you can have access to that. As you have seen, there is definitely a flavor of what Ethiopia has done and what Kenya has done. So I want to start with Kenya, and then I will come to Ethiopia, so that we are able to explain and make you understand the drivers which has led to these outstanding results. Very strong set of results in Kenya. The year which was characterized by tough economic headwinds, high inflation, rising energy cost, and a weakening Kenyan shilling. The good news is that some of this has started to ease off, especially during the last quarter, although the negative impact of that was mostly felt in FY24. This year also had some notable developments, starting with mobile termination rate change. As you remember, in August 2022, the rate was dropped from 99 cents to 58 cents. That continued till February 2023, and from March, for the next 2 years, the rate has now been reset at 41 cents from 58 cents. So the impact of that in financial year 2024 itself was 1.2 billion shilling. On a positive note, the reintroduction of charges for M-Pesa transactions to and from banks enhanced our M-Pesa revenue. Overall, as Peter mentioned about our strategy execution in the different business segments, we have delivered some impressive results in Kenya. Double-digit service revenue growth, 11.7%, adjusted with MTR, goes up to 12.1%. And double-digit growth in all financial metrics, be it EBITDA, EBIT, and operating free cash flow, net income and operating free cash flow. So we already clapped for EBIT. You can also clap for EBITDA. We tasked 187 billion Kenya shilling of EBITDA, a growth of 16.6%. Yeah. Net income of 85 billion, a growth of 13.7%. And operating free cash flow of 129 billion, close to $1 billion mark, not yet there, but very close to $1 billion of earning before interest and tax. Now, moving into the numbers into more details. So how did we get this double-digit revenue growth? The growth came from impressive business segments growth from M-Pesa, mobile data, and fixed data revenue, where we had high double-digit to double-digit growth across all segments of the revenue. The second half of the year registered 14.8% year-on-year growth. You'd remember when you released our half-year results, our service revenue growth was 8.5%. So H2 was a better momentum from H1. I will also give more explanation across all revenue lines in the upcoming slides. The slide on the chart on the right side, it shows the evolution of our revenue contribution. As you can see, M-Pesa now contributes 42.4% of our service revenue. You can also see something which we have not reported this way. We are calling this as connectivity revenue. As you know, voice and messaging is always under pressure. It will continue to be under pressure, and we will see a corresponding growth in mobile data. So combining all of this, we wanted to show how that contributes and how is the growth profile. The connectivity revenue contributes 52.7% of revenue, which includes voice, messaging, and mobile data, and that's growing 6.2% year over year. Now, if you go back historically, this is the one line where we have not grown more than 3% over a long period of time. So this is again a significant uplift in terms of growth driven mostly by mobile data. Now, starting with customer, our 1 month customer growth was 4.6% year over year. Now we touched 34.6 million customers. We have been optimizing our pricing to ensure that customers can still utilize our services and enjoy the value being on our network in meeting their day-to-day needs. Rate per megabits, which has been under pressure over a long period of time, it declined 61% in the last 4 years. But in the last financial, it recorded a decline of 4.6%, which is the lowest that we have seen. Voice rates are down 40.4% in last 4 years. The reason I'm emphasizing this is also to acknowledge, to ensure that we all understand how we have been providing more values to our customers. And that is what is giving us the engagement with the customers in terms of the usage that you see I talk about later. We have revised down our M-Pesa tariff by approximately 61% when you reintroduced charges from bank and to the bank. And all of this is what has resulted into if you can see that the 1 month active customers ARPU grew by 8.6%. So it's an overall growth story. Customers grew, usage grew, led to an ARPU growth, and that's how the revenue growth came up. Now, starting with M-Pesa, which is of course is the major growth engine, contributed 66% of the incremental growth for last financial year. And by the way, that's lower than that we have seen in terms of incremental growth, despite growing 19.4%, simply because the other segments of revenue are also growing. 19.4%, we haven't had this in a normal year over a long period of time. Of course, it got benefited by return to charging, where you got benefit for 9 months. Within M-Pesa, we have seen better traction in the second half of the year. The revenue growth of M-Pesa grew 22.1% in second half compared to 16.5% in the first half. I mentioned about return to charging. I'll talk about, you'll see that how the increased usage has also helped us growing M-Pesa revenue. And in the second half of the year, M-Pesa ARPU grew by 20%, which has led to ARPU growth of 16.1% year over year. Overall, payment ecosystem have done extremely well. The consumer payments grew 15.4%, driven by increased volume. As you know, this is one of our bread and butter revenue stream within the M-Pesa segments, still growing double digits. Business-related payments has an extraordinary year, growing 39.8% year over year. Global payments, which is a smaller portion of M-Pesa, about 2.5% of the revenue, have been growing on a double digit, high double digit for a long period of time, have grown 20% in last financial years. We are now present in 200 markets across the globe on our platform. Financial service category, on the other hand, has declined, which are basically the credit products. It's shown a decline of 9.2% year on year, primarily due to price optimization of our Fuliza product. If you exclude Fuliza, the revenue grew 23.9%. I repeat, financial services declined 9.2% because of price optimization that we have done in Fuliza, but excluding Fuliza, we have grown 23.9%. But on Fuliza, it was all about affordability and allowing more customers to have access, and also a higher value of disbursement, which was reflected in the growth of disbursements by 18.9% year over year. The Fuliza disbursement touched 834 billion in the last financial year. Still on M-Pesa, we have introduced something we have not shown you before. Probably you all do the calculation, but we thought this time around, let us present to you what we call M-Pesa monetization. It's nothing but the effective rate that we get on every transaction on M-Pesa. So this chart basically shows the chargeable transactions that we have for M-Pesa. What is the monetization rate? So overall, M-Pesa monetization for the full year rate it's the way it is calculated, it's 62 basis points was 0.62, remain more or less stable. And this is on chargeable transactions. But on overall transactions, we are at about 35 basis points. And it is quite natural because 43.5% of transactions are still free, and we believe that will continue to be free. So it is all about volumes, and you will see that how volumes and values have contributed to the traction in the transactions and the revenue growth in M-Pesa. So just key highlights on the new growth areas within the M-Pesa. We made some very good progress in the areas. Lipa na M-Pesa, both Lipa na M-Pesa agents and Pochi la Biashara agents. Pochi la Biashara has actually, the numbers have doubled. The number of Pochi la Biashara tills doubled in the year. And combining Lipa na M-Pesa and Pochi la Biashara, this makes up 21% of the business payments, is actually contributing 11% of the growth in M-Pesa, which is quite credible. Lipa na M-Pesa itself grew 38.2% to touch now 7.3 billion shilling revenue in last financial year. So we continue to invest and drive innovation of new products as we increase our service offerings to our customers. Now, as I mentioned about usage, if you can see this on this chart, I'll start with the volumes and values. So we continue to expand our ecosystem in M-Pesa. The total value and volume of M-Pesa transactions grew 9.6% and 33.9% year on year, reaching 40.2 trillion Kenya shilling in value and 28.3 billion transactions in last financial year. As I mentioned, 43.5% of value and 56.9% of volume of these transactions are non-chargeable. Mostly the transactions reflecting, we call that Kadogo transactions, P2P transfer of 100 shilling or a Pochi la Biashara or merchant payments up to 200, those are free, and that's what it contributes. We believe that's how the affordability is driven into the M-Pesa ecosystem, and that's helping and supporting to grow the M-Pesa ecosystem bigger and broader every year. The bottom right chart shows the chargeable transactions, which is what drives the revenue in M-Pesa. The transactions value grew by 52.5% and volume grew by 45.6%. And the most important KPIs for M-Pesa to look at is chargeable transactions per customer per month. Not too long ago, pre-COVID, we were about 10 to 12. The year now we have closed, we reached 31.5 for the whole year. A growth of 33.9%. So we closed last year with 23.5 transactions per customer per month. This year we closed at 31.5 transactions per customer per month. And that's what has driven, as I mentioned before, a 16.1% ARPU growth in M-Pesa. Now, another growth area for us and something we are very proud of, our journey to digitize payment platform and embrace technological innovation is on track. M-Pesa Super App plays a pivotal role in this digitization. The consumer Super App, which is on the left side of the chart, is gaining traction with 9.6 million downloads, and 3.6 million of those customers are active customers. Last financial year, we generated 11.3 billion in revenue from consumer Super App, which is a 68.7% growth year on year, and contributing 8% of M-Pesa's overall revenue growth. Contributing 8% of M-Pesa's overall revenue. Super App, consumer Super App has facilitated 780 million transactions, totaling Kenya shilling 2 trillion in value. This is again a growth of 59.4% year over year. These are big numbers, and you'd recall Super App is not necessarily, we have not launched it long back, it's just two years. So the traction, the the momentum it's gaining is quite credible. On the Business Super App is also quite good. We have 1.5 million downloads and over 140,000 active customers, generating 663 million in revenue, facilitating 53.1 million transactions valued at 505 billion, and this has more than doubled compared to last financial year. And normally we provide more details on M-Pesa, which you will see in our results booklet, which will be published pretty soon. Coming to another growth engine for us, which is mobile data, which has done exceptionally well in last financial year, growing 18.2% year over year. And contributing almost 1/3 of the incremental growth that came in the last financial year. Again, second half of the year was better than the first half. We grew 23.2% in second half compared to 12.5% in first half. We again have a very balanced story. We have customer growth of 13.9%, usage growth, and that led to ARPU growth of 1.5%. Smartphone users have grown by 13% year over year, now to touch 22.9 million, and 76% of those are now 4G enabled handsets, reaching now 17.5 million customers. I'm also happy to share that it's still small, but 670,000 of those 4G plus devices are 5G devices, and that's also growing in our ecosystem. I mentioned about rate per megabits that has declined 4.6%, which is the lowest that we had in the recent years. And we continue to support customers in acquiring 4G enabled devices through our affordable Lipa Mdogo proposition, which we call LMM. This has enabled over 1.2 million customers to enjoy more features at their convenience, along with open market partnerships. And with the launch of affordable 4G smartphone local device assembly, we believe a significant boost in smartphone penetration is likely to come in the near future. So these developments signify our commitment to enhancing customer experience and fostering greater connectivity in the digital age. Now, coming to fixed revenue, overall fixed revenue grew 12% year over year, still double-digit growth, and it's one of our growth engine. Within that, fiber to home contributes 42.9% of the fixed revenue, have been growing much faster at 31.1%, and also adding customers, almost 1/4, 27% growth in the customer base to reach 250,000 homes in the last financial year. These advancements highlight our commitment to enhancing our fixed service offerings, expanding our customer base, and venturing into a promising technological domains. The last, but still important segment of our business, voice and messaging. We have consistently, as I mentioned before, we have consistently optimized our pricing to ensure that our customers can enjoy the most value at competitive price points. This approach has been our long-term commitment and has given us significant results in the way we have seen the voice revenue development over the years. For the full year, voice revenue declined by 1.7%, but within that, we had a decline of 3% in the first half, but an improvement in the second half, more or less stable at a 0.5% decline. We have seen, which is very different from some of the countries, the advanced countries where usage is going down. We see a growth in our usage in voice as you are optimizing prices and offerings. A 15.9% voice usage growth to an average of 189.4 minutes in the last financial year. One star performer, and let's not forget about something called messaging, which still exists, and close to 22 million customers are active on a monthly basis. That's growing 8% year over year. And just to remind all of you, this is the second year of messaging revenue growth we have seen after probably decline of 3-4 years in the past years. Through our integrated bundle offers, we managed to bring this back on track and managed to stop the decline in revenue. Looking ahead, I think this is voice and messaging is one of the area that we need to keep watching the way it has happened in other markets. That's why you're talking about connectivity revenue. The voice messaging revenue gets replaced by mobile data revenue, and overall we have to see that that's growing as per our plan. And as I mentioned, that grew 6.2%, connectivity revenue grew 6.2%, driven by customer growth as well as by ARPU. So that was on the top line side on Kenya. Now coming to the cost, I mentioned about the macroeconomic challenges that of course gets reflected in our cost. Starting from operating cost, which is on the right side of the chart, as you can see, it grew 11% year over year. And that growth is majorly driven by increased network operating cost, lease cost, and foreign exchange losses. If we remove the energy cost, which has grown, the rate's gone up by 40% year over year, the operating cost would have grown by 4.3%, which is lower than the inflation in the country. On the left side, you see the direct cost growth. It shows a decline of 0.7%. This is majorly driven by the decline in the device sales. But if you normalize, if you take out the impact of device cost, it grew by 3.6%. Still much lower than typically the direct cost growth that you see in conjunction with the revenue growth. And I wanted to remind you, remember we spoke about return to charging. So when return to charging happened, it's not only boosted our revenue, it did also help to see a commission optimization in the M-Pesa ecosystem because of deposit volume reduction. And we were not earning any revenue through deposit. We still don't earn any revenue on deposit, but the commission we are paying before has come down, and that's why you see a much lower growth in direct cost, excluding handset cost. On debt and finance cost, the one area I want to highlight is the interest cost, which is a major area of concern. We have seen interest cost because of interest rates. Our debt level is more or less stable, whether it is gross debt or net debt in whatever you calculate. But because of interest rate, as you can see, the interest cost has grown over 45% year over year. As you know, the treasury rates have gone up significantly compared to last year, and that's what's reflecting. We have enhanced our debt portfolio by sustainability linked loan, which we took about 15 billion last year. And normally the rates are lower because these are also linked with our ESG goals. And in any case, we are doing very well on ESG. So that also helped us to cushion some of the interest rate burden that we have last year. And on a more positive note, our net debt to EBITDA at 0.29, 0.3 is probably one of the best that you can compare the similar size of telco across globe. On cash flow, very healthy growth of 15. Free cash flow grew by 15.7%, touched 76.1 billion. And as you can see, it's majorly driven by the EBITDA growth. And this free cash flow growth is what enables us to invest more in CapEx, invest in Ethiopia, and that's what we have been doing through the growth in free cash flow. So on financial KPIs, just over the last 4 years, our Kenya performance indicators remains very strong and resilient. Our innovations and customer propositions are supporting top line and increasing our revenue. Our productivity initiatives have helped us to cushion the growth and the cost side and delivering more values to our customers and also improving margins. In FY24, our EBITDA margin, we closed at 54.7% and EBIT margins at 40.7%. This is the best improvement and the best that we had in the recent history. Our OPEX intensity at 17.4% is quite stable and compared to any other benchmark telcos. And our return on capital employed at 70% is probably one of the best in the telco. But this also gives us enough headroom for us to invest and give more return to our shareholders. Now, coming to Ethiopia, I won't dwell a lot on some of the things that Peter has already mentioned about, especially starting with the revenue profile. This revenue is beginning to add to the overall story for group. We had a 5.4 billion Kenya shilling equivalent revenue last year in Ethiopia operations, and 72.6% of the revenue is mobile data. So 72.6% mobile data revenue is actually what is helping us to grow, because that's the network that you're building in Ethiopia, and that's visible in terms of service revenue growth, in terms of 1 month active ARPU growth, and also the usage that Peter spoke about. On customer and usage, I won't dwell a lot. Peter has already spoken a lot about this. As you can see, we have now touched 2,806 sites, and then especially on the usage side, as you can see, 90-day active data users touched 2.8 million, and that's almost 70% of the voice users. And then data usage per GB was 4.3 GB per customer per month. Now, from a funding perspective, let me start with the CapEx. So, at the end of FY24, our cumulative CapEx investment in Ethiopia was $853 million US. And we spoke about in our previous results release, and including in our February roadshow, a CapEx for 5-year CapEx level of 1.5 to 2 billion. Now, with the level of achievements, with the level of traction that we had so far, with 2,800 sites which you have, and the scalable number of sites that you will have, we believe the 5-year CapEx numbers is possible within 1 to 1.3 billion. So we are revising it down, our outlook for the CapEx for the first 5 years, which is the peak investment period, from 1.5 to 2 billion to 1 to 1.3 billion. And we've spoken about 10 to 12,000 stations, base stations in 10 years' time. We are talking about 8 to 10,000 base stations in 10 years. And we believe this will be sufficient to take care of our coverage obligation, and also to give our customers the digital experience that we have promised and that we are providing already. In terms of funding, Ethiopia has been funded, fully funded. They're well funded. So as on FY24, the total funding was $1.86 billion, out of which 1.6 was equity. And then we had $100 million of IFC funding, and then local currency equivalent of $134 million. And out of the $1.626 billion investment by cash equity, Safaricom share was $840 million. In addition, as we spoke about before, we are also utilizing deferred payment from our vendors. At the end of FY24, that amount was $301 million US. Coming to group net income, Safaricom Kenya net income grew 13.7% year on year to 85 billion, majorly driven by our top line growth. During the year, we had a hyperinflationary impact for Ethiopia, which we adjust in group income of overall 7.4 billion Kenya shilling. And that is coming in combination of hyperinflationary monetary gain of 22.4 billion that you will see in the income statement. And income statement line was restatement of 15 billion negative. So there is a gain of 22 billion and negative impact in the P&L line items of 15 billion. That is what is leading to a 7.4 billion gain in hyperinflation impact in FY24. And although we are seeing inflation coming down in Ethiopia, but consumer price index continues to be growing. And that's why we needed to apply our IS 29, and that's what has led to the impact of 7.4 billion. Our group net income excluding minority interest, Peter mentioned about it, grew by 1.2% year on year to Kenya shilling 63 billion. And I want to highlight about this. This is a reflection of startup losses from, we are still investment phase, startup losses from Ethiopia, and the momentum that I spoke about for Kenya. In terms of CapEx, this is what drives our engine. This is what has helped us to build 2,800 base stations in Ethiopia. Overall group CapEx, we closed at 93.5 billion. Within that, split is almost 50-50 between Ethiopia and Kenya. As you can see, the the blue section in the pie chart, the majority of the investment is coming for radio access network, even for Kenya, but almost 2/3 of that is coming for Ethiopia. So this is what has supported our rollout and also improving our customer experience and additional rollouts in our 5G, which you have closed now 906 sites as on end of a financial year. Now, looking at overall performance for the group, once again I want to reiterate, outstanding performance in Kenya with impressive double-digit growth across from top line to bottom line. Ethiopia first full year of operations, supporting top line growing from Kenya's 11.7% to group of 13.4%. So it's an uplift from 11.7 to 13.4, which is what Ethiopia is going to do in future. And the numbers also reflects on constant currency without translation loss. If I remove the translation loss, EBITDA actually grew for the group 19.2%. EBIT almost flat, and group net income excluding minority interest growing by 4.2% year on year versus the reported growth which you spoke about, Peter mentioned about 1.2%, which is very encouraging. So I want to highlight here is something that is very important for you to take away. We believe the worst is behind us from a group financial point of view. Although you have seen Kenya's performance is extraordinary, but when you report our group numbers, of course we have seen some headwinds, has some tailwinds in the last 2 years. But I want to confirm that worst is behind us. So when you see the group income or group numbers, you have to see Kenya separately and Ethiopia, because Ethiopia is in investment phase and such a big greenfield with large investments is expected to have losses. And we believe whatever losses Ethiopia had is within our expectation. So as the business gains scale, Ethiopia will have positive impact to our group performance in the coming years. Ladies and gentlemen, this brings me to the end of my presentation, and we are very much looking forward to building on the gains we have made in the last financial year and before into the new financial year. Just to mention again that result materials will be available in our website shortly, and thank you for your time. I now invite Peter to give the additional remarks for FY25 guidance. Yeah, you can clap a little bit more if you like. Thank you very much.
Just wondering, where did they get that photo from? Did you see my photo? So anyway, clap for Dilip again, our CFO. When we were preparing for this, we were saying to the CFO, he needs to smile. It's very good numbers. So a great Dilip is looking very, very, very happy. So thank you, Dilip. And ladies and gentlemen, let me take now the moment to summarize the key drivers of these impressive numbers that Dilip has presented. We have delivered outstanding results amidst a tough operating environment, outperforming the group guidance, which was a revised one at H1, and in particular, stellar performance in Kenya. So to summarize, we continue to have a strong and broad-based Kenya business, as evidenced by the results. We are encouraged by the commercial progress in Ethiopia, which will start being a significant contributor of growth, both to the group, both at a top-line level, but also an accelerator at the bottom line, given this is the highest peak cost here. We continue being a tech partner of choice for digitizing Kenya. The local device assembly, which we launched in the previous financial year, continues to accelerate the smartphone penetration, which is critical for us to make sure that everyone gets onto the internet and no one is left behind. We have seen real value from our investment in technologies, and we want to be a tech core, such as big data and analytics, delivering greater value to our customers. So, ladies and gentlemen, as you know, financial year 25 is the end of the previous strategy horizon. So this financial year marks the end of our Vision 2025, which is which is to create a purpose-led technology company. Together with the board, and you'll hear more from the chairman, we've identified our new vision and 5-year strategy that will see us becoming Africa's leading purpose-led technology company by financial year 2030. Our key pillars to deliver this vision will be a focused approach to defending and growing our connectivity business. You had the CFO referring to our connectivity business as it matures, especially in Kenya, but also accelerates in Ethiopia. But also our mobile financial services business, some of which is mature, but a lot of which are also growing. We'll also accelerate the transition to TechCo whilst evolving Ethiopia into a full-scale, sustainable digital business. So what does this mean from an outlook perspective? And this is from the perspective of a medium-term outlook. For Kenya, we expect to maintain the service revenue growth momentum, with M-Pesa and fixed revenue expected to grow at double digit. Our GSM, which is our connectivity business, should grow in high single digit, which is a significant step up from the previous low single digit. Our EBITDA should remain stable, including a stable CapEx intensity, which is CapEx a percentage over the period. Ethiopia is still within expectation, and you heard the CFO talking about it, with respect to the medium term, both in terms of expectation, but also in terms of funding and investment. Ethiopia earning before interest, tax and depreciation. Ethiopia earning before interest, tax, depreciation and amortization, this is a finance term, is expected to break even, and this is important, within year 4 of its operation, as we have guided before. We expect to have 15 to 20 million customers with a network of just over 4,000 sites in the medium term in Ethiopia. Having looked at our next vision and the medium term outlook, let me turn on to focus on what we intend to achieve in the current financial year, which is our new financial year 2025. Our focus is to embed customer first, so customer will continue to be a critical enabler of how we look at our business. Customer first, tech capabilities, including capabilities of our people, but also externally, as we work to being Africa's leading purpose-led technology company by 2030. So by the end of this financial year, we want to offer our customers a seamless digital-first experience. In fact, I should say a seamless, always secure, always on. And some experts are smiling at me in front here. Always secure, always on, worry-free. Yeah, worry-free, seamless digital-first experience. We want to unlock more value through segmentation. And the worry-free piece, you'll hear another announcement coming in the next month or so, especially on an M-Pesa business. So we want to unlock more value through segmentation, which we have started the journey in financial year 2024. We'll invest in more tech capabilities, in particular within our organization, so that we don't leave any employee behind. And we are calling it 2+1. We'll scale the fixed business, which we need to accelerate to connect more homes and more businesses, so that everyone has broadband connectivity in addition to mobile. We will keep the momentum for the Ethiopia's commercial execution that you have seen. And we have a CEO of Ethiopia, and when we go to Q&A, we'll be able to answer more questions there. So let's now, that is in terms of focus on financial year 25, but also the medium-term outlook. Let me now turn on to the guidance, which is for investors for financial year 2025. So based on our performance and on the focus areas for the year, our financial year 2025 guidance is as follows. For Kenya, earning before interest and tax will range between 149 billion to 152 billion Kenya shillings. For Ethiopia, the EBIT loss will be in the range of 46 to 43 billion. This brings the group EBIT guidance to a range of 103 to 109 billion, which is a significant growth if you compare it to financial year 24. On CapEx, Kenya CapEx guidance is within the range of 52 to 55 billion, which is an increase of the current year as we continue to invest for growth in future. For Ethiopia, recognizing that we have had an accelerated CapEx investment in the past 2 to 3 years, our CapEx guidance will range between 21 billion to 24 billion, which is still a very significant increase as we target to get to 3,500 sites by the end of the year. So the group guidance, the group CapEx guidance, therefore, is the range of 73 to 79 billion Kenya shillings equivalent. Additionally, for Ethiopia, we guide more because it's a startup business. We'll continue to acquire or drive acquisition of customers. We are targeting to grow our 90-day GSM, which is our connectivity customers, to between 7 and 10 million customers, and M-Pesa 90-day active customers at a range of 2.5 to 4 million customers. So in conclusion, ladies and gentlemen, we are very proud of what we have been able to deliver in financial year 2024. I'd like to thank the chairman, Adil, and the board, many of whom are represented here. I can see some in the room and probably also online, for the support accorded to myself and also to my entire leadership team and the organization. To Safaricom group staff, and we'll have another session with the staff later on, thank you for your hard work, both in Kenya but also in Ethiopia, that you have put in tough environment. To all our stakeholders, especially our dealers, our agents, but also our suppliers, I thank you for your support and the confidence that you have shown in Safaricom. And finally, I want to thank our most important stakeholder, which is our customers. I want to thank our customers for their business, their loyalty, their confidence in us. They are the reason why we operate, and we know there are some tough circumstances, and we'll continue to be with you, whether through the way we offer our services, the way we drive the support, especially through our foundations, for recognizing what is going on at the moment. I thank you very much for your continued support. So ladies and gentlemen, thank you for joining us physically, and for those joining us online, I want to thank you for your time. Asanteni sana. Now I want to welcome, you don't want to clap, I now want to welcome our chairman, Adil, to make his closing remarks. Thank you very much.
Good morning, everybody. Just trying to get my machine open. I think my machine agrees too that there's nothing I can say after what Peter and Dilip has said. And we say, do I say? These are the excellent results. Esteemed shareholders, representatives of the investor community, the board, management, and staff of the Safaricom Group, members of the media, the online community, invited guests, ladies and gentlemen, good morning again and welcome. It's my pleasure and privilege to join you for the financial results announcement for the year ended 31st March 2024. As you have already heard from Peter and Dilip, despite the various challenges, we successfully steered the company to achieve the impressive results that we are announcing this morning. We witnessed a peculiar operating environment in Kenya. We pressed on with our expansion in Ethiopia and took all the startup obstacles in our stride. The board is proud that despite the tough economic environment, the company has been able to perform extraordinarily well, and we have registered positive returns for our shareholders. The board is delighted with the business performance, particularly emphasizing the notable double-digit growth in earnings before interest and tax. And as mentioned by Peter, it's a proud moment for all of us at Safaricom to hit the $1 billion mark on EBIT. Ladies and gentlemen, this is no mean feat. There isn't another company in our region that has reached this, so this is amazing. Firstly, I must acknowledge the unique conditions under which Safaricom has operated over the past year. In Kenya, like many other companies, we faced major macroeconomic challenges, high inflation, a weakening shilling, effects of the prolonged drought, and rising taxes. We navigated a rapidly evolving regulatory landscape. We also had to contend with changes in taxation and mobile termination rates. We embrace the growing needs of our various stakeholders across Kenya and Ethiopia and continue to contribute meaningfully to their social and economic development. Our continued expansion in the Ethiopian market, signified by our belief in the potential of the business, was in keeping with our growth strategy. Despite the inherent challenges of establishing operations in a new market, and for that matter one that has just opened up to competition, we have laid the foundation for a strong business relying on sustainable partnerships intended to positively contribute to Ethiopia's digital transformation. Ladies and gentlemen, I want to assure you that Safaricom remains committed in delivering value to all our shareholders. During the year, the board approved the payment of an interim dividend of 55 cents per ordinary share, which amounted to 22.04 billion shillings. The board has further resolved to recommend to shareholders at the forthcoming AGM in July a final dividend of 65 cents per ordinary share. This brings the total dividend payable for FY24 to 1 shilling and 20 cents per share, which is equivalent to a whopping 48.08 billion shillings. You will have noted that we are paying a similar dividend as last year, despite registering the highest EBITDA loss in Ethiopia. So you must see that Kenya business has really pulled its socks up, and we hope that it's only the beginning of things to come. Our current vision is to become a purpose-led technology company by the end of 2025. The Safaricom board, in conjunction with the management, have just completed the new business strategy to run until 2030. As earlier detailed by Peter, the vision charts are course towards becoming Africa's leading purpose-led technology. For those of you who heard it, the addition is Africa. We have already dealt with East Africa, right? So we now want to go to Africa. In this financial year, we continue to come closer to the communities we serve. The board is committed to support management in running a sustainable organization driven by our purpose of transforming lives. Safaricom has been actively involved in supporting communities, as you know. Safaricom has been at the forefront of all government of Kenya and private sector efforts to distribute relief food during the prolonged drought. And now through our foundations, we are supporting communities who have been affected by the recent and ongoing floods. Just to add, which Peter didn't tell you, he's going to be leading the private sector initiative, so well done, Peter. I acknowledge the good work that both M-Pesa and Safaricom Foundations have done this financial year, and I do look forward to seeing more of our board members participate and join the staff in activities that support our communities. As a board, we will continue working with all our stakeholders to ensure that our strategy, vision, and purpose reflect and meet the needs and expectations of the individuals, communities, and entities that are impacted by what we do. I would sincerely like to extend my appreciation to my fellow board members for their hard work, wisdom, and strategic guidance. Their insights and leadership have been instrumental in steering Safaricom to achieve these results. Thank you. On behalf of the board, I would like to commend the management team and all the Safaricom staff, without whom we would have not been able to deliver these impressive results. The commitment of excellence and innovation of our staff is second to none. Did I add, did Peter highlight that we are the best employer and that we have the most engaged staff? So just keep that. At Safaricom, we place immense value on the relationships that we have with our stakeholders. We remain committed to collaborating with the government, regulatory bodies, policymakers, and all stakeholders to drive positive change and deliver sustainable growth. On behalf of Safaricom PLC, I would like to express our sincere gratitude to the governments of Ethiopia and Kenya for their support whenever we require it. The alignment of our strategy with the national programs has been a crucial ingredient to achieving our impressive results. We hope to continue to build on this. As I conclude, Safaricom's journey over the past financial year reflects resilience, innovation, and a deep commitment to our purpose. You've never heard us complain about the difficult economy. We just get on and do it. As we expand our footprint into Ethiopia and continue to lead Kenya, we are confident in our ability to drive positive change and create value for our company, our customers, and the community we operate in. Lastly, customers, we owe you a share of this glory. You have contributed to it, and we assure you that we will continue to serve you and serve you better. Thank you, ladies and gentlemen.